Hello and welcome once again to the Capital Spreads weekly video. I'm once again joined by our esteemed colleague Bill Hubard, Chief Economist of Markets.com. Thanks very much for joining us again, Bill. I think I'll start off with the most obvious question right now. Anybody that's watching the markets today will see that they're coming off again.
Yes.
Why do you think that is?
Well, I think it's basically a situation where the market, after we got the FOMC minutes, and they were somewhat downbeat, everybody said, oh, Bernanke, the big bazooka tomorrow, QE3 or whatever he's going to announce. Well, I think what they began to realize is that he's not going to. And if we go back to August of 2010, when he did announce the final, qualifications for QE2, within 16 months we saw the S&P go up 25%. So the market anticipated, well, maybe tomorrow we will get something QE3 or Operation Twist Part 2 or whatever. So like anywhere else, we bought a hit, we bought the rumor, and now the last 2 or 3 days, there is no rumor. And yesterday we got the beige book, didn't tell us anything we didn't already know, but one of the things that the market, at least the analysts began to realize, the FOMC minutes, a month old, the beige book more current, saying it slowly and gradually, housing market in the U.S. improving, consumer spending improving. I think we got some very good earnings out of like the retail shops in the U.S. today. And basically my feeling is Bernanke tomorrow will basically tell us, hi, I'm going to keep my options open. And one thing where he won't say this, but in the back of his mind he's saying, I'll let Mr. Draghi next Thursday with the ECB, feeling maybe he has enough confidence in what Merkel may or may not do in the Constitutional Amendment Congress on the 12th of September. Maybe Draghi will say something about we will start a program of buying short-term Italian and Spanish bonds, and then of course you've got to wait until next Friday's non-farm payroll. My early call is only like plus 100,000. And one of the things I think we need to inform, our listeners is from 2008 to 2011, QE1, QE2, Operation Twist, we're talking $2.3 trillion in bond purchases, but it still has not brought the U.S. unemployment rate below 8%.
No. Obviously people are watching the Jackson Hole meeting tomorrow with Ben Bernanke and, as you mentioned, the ECB next week. One of the points that many people seem to be highlighting at the moment is Draghi's not actually attending tomorrow. How do you read that? What's the reason behind that?
Well, it's already telling he's very busy. The market is now, I think, feeling that he's very busy, is it hopefully, wishfully praying, whatever, that he's putting the final touches on to doing, again, becoming Super Mario. Saying that I will go against the grain, or go against the general feeling, whether it be in the Eurozone, that the ECB will start trying to do what we can with them in our limited mandate of trying to get the Eurozone up and running again.
Okay. Obviously there's a number of key issues and topics floating around at the moment that people are focusing on. Many people are obviously expecting QE at a number of key central banks. Greece is still up there being tossed around. What do you think is going to be driving the markets in the next few weeks, and what do you think is going to actually happen off the back of everything that's happening right now?
Well, I think one of the things we have to look at is, remember, tomorrow is the end of the month. Monday is a U.S. holiday. I don't have to tell anybody in the marketplace we've had no volumes to speak of for 6 months. So it's one of these things where if I can come up with any reason not to do anything. And so, but the point you just said is next Thursday, we have the Bank of England and the ECB. The Bank of England will do nothing. I expect more QE, whatever you want to call it, from the Bank of England, but not until the November meeting, which is the inflation. I know there's some people out there feeling that the ECB could surprise us next week with a rate cut. I am not expecting that rate cut because they could take the coward's way out until the 8th of November. Why is that important? It's 2 days after the U.S. election. So I think that's when we get something, and I am expecting 25 basis points. Again, we'll get non-farm payrolls. My early call is plus 113,000, but that still doesn't do anything with that magic 8% unemployment level. So really it's going to be a question of, there's no magic elixir, there's no magic pill, there's no magic book. It's going to be a situation where we will continue to have, I think, before you even ask me, yes, I've changed my position on the euro.
That was a point I had written down.
We were advocating, and we did. We got clients to go in at 24.88, which is a major level. We feel it could go to 127, but 127 will be the ultimate, whether it's this month or next month. And I'm not as bearish as some people out there. There are some people out there that are predicting by the end of next year we could be back to parity. But it's a question of, again, to answer your question, you've got one or two players, whether it be algorithmic trades or whatever. So if they're going against the grain, and everybody's out to lunch, gone to the loo or this, that, and the other, that you have incredibly small volumes moving the market right now. So I could see, yes, 125.50, 126, whether we get to 127, but because of what is happening in the market, yes, you can't go against the trend. But the simple fact is, I would be heading towards the 127 level. I would get no higher than that, and then I start selling it again.
So you're still long-term bearish, basically, the euro?
Right. Come on, I've been long-term bearish from the euro since 1957.
One point that you mentioned, which was obviously the presidential election in the US. I mean, it is a bit topical, but what do you think of Obama's chances of being re-elected? And if he didn't get re-elected, would you think things would change?
I guess I have to say that, again, it's all very easy to talk about any election, but you can say anything you want to YouGov or one of these polls, but when you go into that polling booth, no matter whether it's here or in the US, you're going to look at your checkbook, you're going to look at the coins in your pocket, and that's what you're going to vote with. I think the most recent YouGov poll, and I hope it doesn't upset certain people, but I think Mitt Romney is more negative, and has been the most negative candidate going against an incumbent president since 1984. And I think it really is going to be a situation where, when push comes to shove, I would be very concerned. And I guess you go back to 1936, when President Roosevelt was going up for re-election, and the unemployment rate was 7.5%. I mean, his comment was, "Don't change horses in midstream." And I think that's what people will probably come back and say, "Well, wait a minute. He did the best he could in a bad situation." So, I am confident. I believe that Obama will be re-elected in November.
Just one final point.
Sure.
Your comments last week for your tip of the week was the gold platinum long-short trade.
Yeah.
How do you feel about that this week?
I'm still gold is 1750. Platinum will be one of these things where it may be affected by what's happening in South Africa.
Absolutely, because it's still kicking off.
But the simple fact is, as a trade, I would be long gold.
Well, thanks very much again, Bill. Thanks very much for watching. Please feel free to join us again next week. Thanks a lot.
Cheers.
Thank you.